Here's a number that should stop you in your tracks. The average American will earn somewhere between $1.5 to $2 million over their entire working life. Think about that. $2 million passing through your hands, and most people will retire with almost nothing to show for it. Not because they're lazy, not because they're stupid, because nobody ever sat them down and explained how the game actually works. Today that changes. Let me give you some real numbers so you understand what we're dealing with. The Federal Reserve, which is the central bank of the United States, keeps track of this stuff. And their data shows something depressing. The typical American household that's getting close to retirement age has about $87,000 saved up. That's it. A lifetime of work, 40 years of showing up, grinding, paying bills, and they end up with less than $90,000. Think about what that means in real life. If you need to live off that money in retirement, $87,000 might cover 3 or 4 years of basic expenses, maybe 5 if you're really careful and don't do much. But here's the thing. People are living longer now. If you retire at 65, you might easily live another 20 or 30 years, so the math just doesn't work. Now here's the crazy part that nobody talks about. There's another group of Americans, same jobs, same salaries, no inheritance from rich parents, no lottery wins, no lucky stock picks. These people will retire with 10 times that amount, 20 times, sometimes 50 times more than the average person. What's their secret? Did they have some insider information? Did they work on Wall Street? Did they get lucky with Bitcoin? Nope, none of that. They just understood one simple thing that most people never figure out, and they started early. If you're sitting there in 2026 with zero investing knowledge, no financial background, and no rich relatives to lean on, this video is for you. By the time we're done, you'll know exactly what to do, which accounts to open, what to buy, and most importantly, how to keep yourself from messing it up when the market freaks out and every headline screams that the world is ending. Let's start with the most basic question. Why do we need to invest at all? Why can't we just keep our money in the bank like our grandparents did? The answer is one word, inflation, and inflation is the silent killer of cash. Right now, inflation in the United States is running at about 2.4% per year. That's actually pretty mild compared to a couple years ago when it spiked above 9%. The government tries to keep it around 2% because they think that's healthy for the economy. But here's what 2% inflation actually does to your money. Let's say you have $50,000 sitting in a checking account earning basically zero interest. After 1 year, because of inflation, that money buys about $1,000 less stuff than it did before. You didn't spend it. Nobody stole it. The prices of everything around you just went up. After 10 years of 2% inflation, your $50,000 only buys what $41,000 would have bought when you started. After 20 years, it buys what $33,000 would have bought. After 30 years, which is about a typical working career, your $50,000 has the purchasing power of roughly $27,000. You lost almost half your wealth without spending a single dollar. That's not saving. That's slow-motion robbery, and it's completely legal. Now, you might be thinking, but what about savings accounts? Don't they pay interest? Even high-yield savings accounts, the best ones you can find, are paying maybe 4% these days. That barely keeps up with inflation. At best, you're treading water. At worst, if inflation ticks up again, you're still drowning. So if cash is slowly dying in your bank account, what's the alternative? What actually grows your money instead of just watching it shrink? This brings us to the stock market. And the stock market has a dirty little secret that rich people have known for generations. Over long periods of time, we're talking 20, 30, 50 years, the stock market has gone up about 10% per year on average. That's before inflation. After inflation, it's about 7% real growth. Now, 7% might not sound like much, but here's where the magic happens. That 7% doesn't just add up, it compounds, and compounding is the closest thing we have to a real-life magic trick. Let me show you what I mean with a simple comparison. Scenario 1. You put $500 every month into a savings account earning 4% interest. After 30 years, you have about $346,000. You put in $180,000 of your own money over that time. You earned $166,000 in interest. Not terrible. Scenario 2. Same $500 every month, same 30 years. But this time you put it in the stock market, and it earns the historical average of 10% per year. After 30 years, you have approximately $1.1 million. Same contribution, same time frame. But one gives you $1 million, and the other gives you a third of that. The difference is $754,000, all from the magic of compounding at a higher rate. Let me explain why this happens. At 10% returns, your money doubles roughly every 7 years. At 4% returns, it takes about 18 years to double. So over 30 years, your money in the stock market gets to double multiple times. Your money in the bank barely gets one double. That's the difference between walking and taking a rocket ship. Same starting point, very different destination. This is why we invest. The alternative, letting inflation eat our savings while we watch from the sidelines, is guaranteed wealth destruction. Compound growth is the only legal way for ordinary people to turn regular, boring monthly contributions into life-changing money. So we know we need to invest, but why stocks specifically? Why not real estate? Why not gold? Why not cryptocurrency? Why not art or collectibles? There are three main reasons, and they're important to understand. First reason, stocks are liquid. That's a fancy word that means you can turn them into cash quickly without losing a bunch of money. Imagine you own a rental house worth $400,000. One day you have an emergency and you need cash fast. Maybe a medical thing, maybe a family situation. You need money next week. You're in trouble. Selling a house takes months. You have to list it, find a buyer, negotiate, do inspections, deal with appraisals, handle lawyers and paperwork. And if you're in a hurry, buyers can smell it. They'll lowball you. You'll end up selling for way less than it's worth. Now imagine you own $400,000 in stocks. You need cash next week. You open your phone, press a button, and sell. The money hits your bank account in a couple days. That's it. Flexibility matters. You never know when life is going to throw something at you. Second reason, stocks are accessible. This is huge for regular people. You don't need a real estate license to buy stocks. You don't need to negotiate with sellers. You don't need a six-figure down payment. You don't need to inspect properties or deal with tenants or fix leaky toilets. You can open a brokerage account in 15 minutes on your phone, deposit $50, and instantly own pieces of the biggest, most profitable companies on earth. Apple, Microsoft, Google, Amazon, all of them, with $50. In 2026, most major brokerages charge zero commissions on trades. Many let you buy fractional shares, meaning you don't need $500 to buy one share of a company. You can buy $50 worth, or $5 worth. The barriers to entry have never been lower. Third reason, stocks have a reliable track record. This is the most important one. Over short periods, a month, a year, even several years, stock returns are all over the place. The market dropped 34% in 5 weeks during March 2020 when COVID hit. It dropped 57% over 17 months during the 2008 financial crisis. It dropped 49% over 2.5 years after the dot-com bubble burst in 2000. But over long periods, 15 years, 20 years, 30 years, the stock market has never failed to recover and reach new highs. Never. The S&P 500, which tracks the 500 largest public companies in America, has produced average annual returns of about 10% since it started. Over the past 30 years, about 10.3%. Over the past 50 years, about 12%. Over the past 150 years, about 9.5%. Different time periods give you slightly different numbers, but the pattern is the same. Patient people who wait get rewarded. Name one other investment you can say that about. Real estate? Maybe, but it's a lot of work and you can't sell it fast. Gold? It just sits there and doesn't grow anything. Crypto? Too new, too wild, too unpredictable. Stocks aren't perfect, they crash sometimes and it's scary. But for regular people building wealth over decades, nothing else comes close. Okay, so we know we need to invest. We know stocks are the best option for most people. Now comes the question that stops everyone cold. What do I actually buy? You have two paths. Path 1, you buy individual stocks, shares of specific companies, Apple, Microsoft, Nvidia, Tesla, Amazon. Some people do get rich this way. If you bought Nvidia in 2019, you've done incredibly well. If you bought Tesla early, you might be sitting on a fortune. But for every person who picked a winner, there's someone who picked a loser. Someone who bought Intel at its peak in 2000 and still hasn't gotten their money back 26 years later. Someone who bought Enron before it collapsed. Someone who bought Lehman Brothers before 2008. The data on stock picking is not encouraging. Multiple studies have shown that the majority of actively managed funds, run by professional investors with teams of analysts and fancy degrees, fail to beat simple index funds over periods of 10 years or more. If the professionals can't do it consistently, what chance do you have researching stocks in your spare time while you're also working, raising kids, and trying to have a life? This brings us to Path 2, and Path 2 is the smarter move for almost everyone. An index fund is a type of investment that doesn't try to beat the market. It just buys everything in a particular index and holds it. When you buy one share of an S&P 500 index fund, you're instantly owning tiny pieces of 500 of the largest companies in America, all in one purchase. You own Apple, you own Microsoft, you own Amazon, you own Google, you own Meta, you own Berkshire Hathaway, you own Johnson & Johnson, you own JPMorgan Chase, and 492 others. If any single company goes bankrupt, say one of them messes up and fails, your portfolio barely even notices. It's like dropping a penny in the ocean. If a whole industry struggles, say banking has a bad year or oil companies go through a rough patch, other industries pick up the slack. Tech keeps growing. Healthcare keeps growing. Retail keeps growing. Your success doesn't depend on picking the right winners. It depends on the entire American economy continuing to grow. And that's something that has happened reliably for over 100 years, through wars, depressions, recessions, pandemics, and everything else. You don't have to be smarter than everyone else. You don't have to be luckier. You just have to own everything and wait. And here's the part that makes this even better. These funds are cheap. Like, really, really cheap. There's something called an expense ratio. It's the fee the fund charges you every year to cover its costs. Actively managed mutual funds often charge between 0.5% and 1.5% per year. That sounds tiny, right? 1%? No big deal. But over 30 years, that 1% fee eats about $200,000 of your money. You're paying $200,000 for nothing. The good index funds charge around 0.03% or 0.02%. For practical purposes, that's basically zero. You keep almost all of your growth. So which specific funds should you look at in 2026? Here are the ones I'd consider. VOO, that's the Vanguard S&P 500 ETF. Expense ratio, 0.03%. Tracks the 500 biggest U.S. companies. Hundreds of billions in assets. Solid as a rock. IVV, that's the iShares Core S&P 500 ETF. Also 0.03%. Same thing. Different company. Managed by BlackRock, the biggest asset manager in the world. SPLG, that's the SPDR Portfolio S&P 500 ETF. Expense ratio 0.02%. The absolute cheapest option out there right now. Any of these will do the job. They produce virtually identical results. Pick one and don't overthink it. If you want even more diversification, you can look at VTI. That's the Vanguard Total Stock Market ETF. It owns about 3,600 companies. Everything from the biggest like Apple down to tiny little companies you've never heard of. Or VXUS for international stocks, or BND for bonds. But honestly, for most people just starting out, a single S&P 500 fund is plenty. Keep it simple. Now we need to talk about where to hold these investments. The type of account you use matters almost as much as what you buy. There are two main categories: retirement accounts and regular taxable accounts. There are two main categories: retirement accounts and regular taxable accounts. Retirement accounts, things like 401ks, IRAs, Roth IRAs, have special rules from the government. They're designed to encourage people to save for retirement by offering tax breaks. Here's how they work. With a traditional 401k or traditional IRA, you put money in before paying taxes. So if you earn $70,000 and put $7,000 into a traditional IRA, you only pay income tax on $63,000. Your taxable income goes down right now. The money then grows without being taxed each year. You don't pay taxes on dividends or gains along the way. You only pay taxes when you take the money out in retirement. With a Roth 401k or Roth IRA, you do the opposite. You put money in after paying taxes. So no tax break today. But when you take the money out in retirement, you pay zero taxes, nothing. All that growth over decades is yours to keep. Pay taxes now or pay taxes later. That's the choice. For most young people, Roth accounts make sense because your tax rate now is probably lower than it will be later in your career. For 2026, here are the limits so you know what you're working with. 401k plans. You can put in up to $24,500 per year. If you're 50 or older, you can add another $8,000 catch-up contribution for a total of $32,500. IRAs. You can put in up to $7,500 per year. If you're 50 or older, add another $1,100 for a total of $8,600. There are income limits for Roth IRAs. For single people, you start losing eligibility at $153,000 of income and are completely phased out at $168,000. For married couples filing jointly, the phase-out range is $242,000 to $252,000. Now there's another account that's like a secret weapon. If you have a high-deductible health insurance plan, you might have access to something called an HSA, Health Savings Account. HSAs are the only account that's triple tax-free. Money goes in before taxes. It grows without being taxed. And if you use it for medical expenses, it comes out completely tax-free, even in retirement. If you're healthy and can afford to pay your medical bills out of pocket now, you can let that HSA grow for decades. It's actually better than a retirement account. The money can be used for healthcare and retirement, and healthcare is one of the biggest expenses older people face. For 2026, you can put up to $4,400 in an HSA if you have self-only coverage, or $8,750 for family coverage. If you're 55 or older, add another $1,000. Once you've maxed out your retirement accounts, you can open a regular taxable brokerage account. No limits, no penalties for taking money out, but also no special tax treatment. You pay taxes on dividends each year and on gains when you sell. So where do you actually open these accounts? 4 names to know. Fidelity and Schwab are excellent all-around choices. 0 commissions, 0 account minimums, fractional share trading, good customer service, physical branches if you like talking to humans, solid apps. Vanguard is the company that pioneered low-cost index funds. Their funds are great. Their website looks like it was designed in 2003 and nobody told them. But if you can tolerate a dated interface, their philosophy is sound. Robinhood has the cleanest mobile experience. It's what got a lot of young people into investing. They now offer IRA accounts with a match program, basically free money for contributing. All 4 are SIPC insured, which means your securities are protected up to $500,000 if the brokerage fails. All 4 do what you need. Pick one and move on. Now here's the most important part of the whole video, the part that separates people who actually build wealth from people who just watch videos about building wealth. Automation? The investors who end up with the most money aren't the ones making brilliant decisions every day. They're not the ones timing the market perfectly. They're the ones who made investing so automatic that they don't have to decide at all. Here's what you do. Set up automatic transfers from your bank account to your brokerage account. Have them happen on payday, every single time, without fail. Then set up automatic purchases of your chosen index fund. The money comes in, buys shares, done. Then you forget about it. Seriously, forget about it. Don't check your portfolio every day. Don't check it every week. Check it once a quarter, maybe once a year. The more often you look, the more often you'll see losses. The more often you see losses, the more tempted you'll be to do something. And doing something is usually the wrong move. How much should you invest? The honest answer is as much as you can sustainably afford. Financial advisors often suggest saving 15 to 20% of your income for retirement. That's a good target if you start in your 20s. If you start later, you'll need higher percentages to reach the same goal. But here's a better framework for most people. Invest whatever amount allows you to keep investing consistently for decades. If investing $1,000 a month stresses you out so much that you quit after 3 months, you're worse off than if you invested $300 a month consistently for 30 years. Start with what you can. $50 a month, $100 a month, whatever works. Then every time you get a raise, increase your contribution. Every time you pay off a debt, redirect that payment to investments. Every time you get a bonus or tax refund, invest it immediately rather than letting it sit in checking where it's easy to spend. Here are some examples so you can see the possibilities. $200 per month for 30 years at 10% grows to about $450,000. $500 per month grows to about $1.1 million. $1,000 per month grows to about $2.3 million. Find your number, automate it, increase it over time. Now, we need to talk about the hard part. The part that has nothing to do with numbers and everything to do with your brain. The stock market goes up about 10% per year on average. But that average hides some really ugly years. Since 1928, the market has been up in about 73% of calendar years. That means roughly 1 out of every 4 years, you end with less money than you started. In 2022, the market dropped about 19%. A $100,000 portfolio became $81,000. People panicked. They sold at the bottom. They locked in their losses permanently. In 2008 and early 2009, the market dropped over 50% from peak to trough. A $1 million portfolio became $500,000. Some investors sold everything. They couldn't take it anymore. And then they missed the recovery. From the bottom in 2009, the market went up over 500%. The people who sold missed all of that. The investors who held on through those crashes, who kept buying when things looked terrible, ended up wealthier than they would have been if the crashes never happened. They bought shares at discounted prices that later recovered and then some. But holding on is hard. Your brain screams at you when you see red numbers. It wants you to do something, anything. Selling feels like relief, even when it's the wrong move. So here's how you prepare yourself. First, keep an emergency fund, 3 to 6 months of basic living expenses in a high-yield savings account. This means you'll never be forced to sell investments at a bad time just to pay for a car repair or a medical bill. Second, only invest money you won't need for at least 5 years, preferably 10. Short-term money, money for a house down payment next year, money for a wedding, money for anything coming soon, belongs in savings. Long-term money belongs in stocks. Cal bill. Third, don't check your portfolio constantly. The more often you look, the more often you'll see losses and the more you'll want to tinker. Set a schedule. Once a quarter is plenty. Once a year is... Remember this, if your portfolio drops 20% but you don't sell, you haven't actually lost anything. You still own the same number of shares. Those shares will recover if you give them time. Fourth, write down a plan. Seriously, get a piece of paper or open a note on your phone and write down what you'll do in different situations. When the market drops 20%, I will continue my automatic investments. When the market drops 40%, I will continue my automatic investments and consider adding extra money if I have it. Writing it down when you're calm helps you follow through when you're panicking. Fifth, be honest about your risk tolerance. If a 50% drop would cause you to sell everything, you need more bonds in your portfolio, even if that means lower returns. The best portfolio isn't the one with the highest theoretical returns. It's the one you can actually stick with. Let's bring this all together with a quick recap before you go. 1. Cash loses value over time because of inflation. You have to invest just to stay even. 2. Compounding is the magic. $500 a month for 30 years at 10% grows to over $1 million. The same money in a savings account grows to about $346,000. 3. Index funds let you own everything. No stock picking required, no luck needed. Just buy the whole market and wait. 4. Use retirement accounts first. Get the 401k match from your employer if you have one. That's free money, then Roth IRA, then HSA if you're eligible, then back to the 401k, then taxable accounts. 5. Automate everything. Set up automatic transfers on payday. Set up automatic purchases, then forget about it. 6. Crashes are normal. They happen every few years. Don't panic, don't sell. Keep buying, the market always recovers. The people who win aren't the ones who make the most money. They're the ones who don't mess up a good thing by panicking at the wrong moment. If you do nothing else after watching this, do this one thing. This week, open a brokerage account. Fidelity, Schwab, Vanguard, Robinhood. Pick one. It takes 15 minutes. Set up an automatic transfer of whatever you can afford. $50 a month, $100 a month, $500 if you're able. Whatever works for your life right now. Set up automatic purchases of an S&P 500 index fund. VOO, IVV, SPLG. Pick one. It doesn't matter which. Then don't touch it for decades. That single action, maintained consistently, will put you ahead of 90% of Americans. You won't need to be smarter than everyone else. You won't need to be luckier. You'll just need to be consistent. Most people know what they should do. They just never actually do it. Close that gap. Start today. If this video helped you understand investing for the first time, hit that like button. It helps more people find it and maybe start their own journey. And subscribe if you want more videos on the real side of money. No complicated jargon, no get-rich-quick nonsense, just simple stuff that actually works. Now I want to hear from you. Drop a comment and tell me, what's the one thing that's been holding you back from investing? Is it fear of losing money? Not knowing where to start? Thinking you don't have enough to make it worth it? Something else? Be honest, be specific. Let's fill the comments with real talk. Maybe your comment will help someone else who's stuck in the same spot. I read them. I'll be in there. Let's figure this out together. Thanks for watching. Start today. Your future self will thank you in ways you can't even imagine yet. See you in the next one.